things which are popular and public is making losses back to back because they learn something over internet not knowing that there are better ways to do things. Now I want to ask you, does it take very high intelligence? Hi everybody, welcome to a real power-packed video about in-the-money covered call options. Obviously you're gonna learn how to do covered call properly, but most importantly, today you're gonna learn why this is one of the least discussed topic over internet. The majority is not aware of it. I'm gonna give you example, will make it crystal clear. You are going to elevate your trading. So brace yourself, something really powerful coming your way, and obviously watch the video till the very end because I'm gonna tell you the adjustments of it. I'm also gonna reveal some secrets about this. People who watch it till the very end and they are serious learners. Knowledge which gives you an edge, no time waste, no fluff. That's not my style. Number one, to make passive income, what maximum retail traders do? Let me show you what do they do. So this is a sample HDFC Bank daily chart I have opened in front of you. Now many people, retailers, obviously this is not a recommendation, just to tell you, this is where HDFC Bank is trading right now. And maximum people who feel that the stock has a lot of power, it can go up now, almost everybody will look forward to sell a cash secured put. That means this is the support here around 1670 levels, roughly 1670, 1671. And obviously bank is trading close to the support. So what is the easy way and low trading IQ way is just to sell a cash secured put. You're gonna find 1,000 videos about cash secured put, how it is got completely fluff. I'm gonna tell you a better way to do it. Selling a cash secured put means you're gonna sell an out of the money put. And if stocks take a U-turn and stock starts to go up, then your out of the money put, it's gonna make money for you because out of the money options contract become zero. Correct? What is the better alternative? Let's see that. We're gonna bust the conventional way and we're gonna throw it out of the window forever. The main difference between in-the-money covered call, which is topic of the day, and the cash secured put, let's discuss it in detail. First, I'm gonna show you option chain so that you are aware of the liquidity, and then I'm gonna explain the concepts completely to you. As we were discussing HDFC Bank, just as a sample stock, it can be any stock, right? It's trading around this level and this is the option chain, and a lot of people look forward to sell out of the money put, right? Out of the money put, which is liquid. If stock go below 16,660, then what they are going to do is that they are going to long the stock in cash or in future. Correct? That's what you've been told so far. So here we are on an Excel sheet, which gonna give you a clear breakdown like no one else. Example, HDFC Bank trading at 1693, I've showed you on the chart. Market lot is around 550 of the bank. Maximum people do this inferior trading way. They sell an out of the money put, which is trading at 18, like I showed you on the option chain. Correct? Now, what the plan is pretty simple, that the stock will take a U-turn and obviously out of the money put will become zero. And by just selling a naked out of the money put, which is also called a cash secured put, a trader will gain approximately 9,900 rupees of profit. If the stock go below 16,660, then your put will be in trouble. Suppose if stock from 16,660 go down to 1,600, then you are 60 points deep in the money. And then you are only left with one option, that you look forward to long the stock now at 1,600. Can you long the future? I'm gonna tell you later. Clear? That's the plan which almost everybody follow, right? Now I want to ask you one thing. When you have to long a stock and you do a cash secured put, you are keeping an ideal money aside. Right or wrong? If your put goes in the money, which has very high chances, market can break support, you know this. You need to have that much of capital sitting idle in your trading account. Now the ideal cash which sits on your demat, on your trading account, does not make any money for you. Right or wrong? Right? If it's the ideal cash is sitting for 1 month, it gives you no interest. In fact, because of inflation, you are losing 0.5% roughly every month. Right? For such a big cash. So there is no point, absolutely no point of keeping that cash idle sitting in your demat account. Right? You're with me on this so far. Is it making 100% sense to us? Yes. So what the alternative which we can do is, instead of doing this inferior thing, what we can do is that we can long the stock immediately. So the view is not changing. You think that the stock gonna go up, you are sticking to your guns. Instead of doing this, you long the stock and you sell a deep in the money call. 1600 call, if you sell of a high blue chip, don't worry about the liquidity. Blue chip always going to have liquidity. If you trade US markets, the same thing can be applied there as well. Option strategies, the techniques remain absolutely same. There is no difference, as you know it. Now, when you do something like this, what's the advantage? The advantage is huge. Number one, if the stock shoot up, suppose stock from 1693 go up to, let's say, 1800. Just example, right? So obviously you're gonna make money from the stock, but your call will become even deeper in the money. How much will it be? 1800 minus 1660, which becomes 140. Pretty simple and clear maths. So if the stock is going up, you are making more money comparatively using your ideal cash by making much more money. Now what you're gonna think, what if stock starts to go down, then what's going to happen? Let me show you. If stock go down from 93 to 1633, the in the money call will be out of the money now, as you know it, and it's gonna become zero, right? So definitely if something like this happens, then around 1633, it's going to be your break even on the downside. Earlier, the cash secured put, your break even was 1642. Now your break even has gone down further. Your profit has gone up using the extra idle cash which is sitting, which is lying in your portfolio. That's why I tell you, things which are popular and public is making losses back to back because they learn something over internet, not knowing that there are better ways to do things. Now I want to ask you, does it take very high intelligence to know that your upside gain is 48% more? 48% more ROI comparatively to cash secured put. Point 1. Point 2, if market go down, your covered call which you sold in the money is going to be out of the money, and then your break even has also gone down. Now a lot of you must be thinking, in the money may not have the kind of liquidity when you exiting, right? Before you have any doubt, let me remove your doubt today right now. If your in the money call gets stuck, can't you do a synthetic exit? If you do not know how to do synthetic exit, I've already made a video on this channel. I can put a thumbnail, I can tell you in the comment section, but I'm not gonna tell you. You figure out channel name and how to exit illiquid call, and you're gonna have detail in a short amount of time, just 5 minutes. I can tell you 80%, 90% of the things, but I'm not gonna do the legwork for you. That is something for you to figure out, because I'm making videos for the go-getters, for the learners, people who really are sick and tired of their trading performance. They want to improve it in a shortest amount of time possible. Now I'm going to tell you the margins, how you can really cut your margins. I'm going to throw light on adjustment as well. But before that, if you are really serious about learning about options, want to learn the top shelf stuff, adjustments, profit booking technique, how to completely flip the tables and get the trade in your favor, time for your favorite VIP points. Can you do this with futures instead of cash to save cost? I know that many of you may want to use the idle cash in other strategies. Can you use futures? Can you use synthetic futures? Absolutely. No doubt about it. How much margin impact you're going to have? Very little if you use futures instead. Do you want to see? Let me show you. So here I've made a basket of cash secured put. Now if I show you here, if you simply sell the put, it's gonna ask you margin approximately 125 roughly. Done. Now instead of this, if you use future, then what is going to happen? This is what going to happen, that your margin requirement will just slightly go up. If you have cash lying in your demat account, that is even better. But if you want to save cost, you can do that here as well. How easy, how effective this is going to be. It's not a cash guzzling strategy. Let other trader trade inferior way of trading. You have a definite better things to do. Remember, it becomes a killer move if it's on dividend paying stock. You want to know more? Yes. Now, if you select a stock and you do a in the money covered call, the profit can be insane. If your stock also gives you dividend, then it's even better. This is better than the cash secured put, which I see everybody doing, needs to be completely removed from your trading. Why? Because when you long the stock in cash, you know your dividend is going to be good. Your break even is almost same. Plus you're going to make 48-50% more ROI when you trade in the money. Nobody do in the money, let me tell you. Everybody do out of the money or at the money call. Not realizing that a little tweak, just a little tweak can be so powerful, can really make your returns high, keeping your risk same. Also, rolling in the money covered call forward to lock your gains, easy peasy. Now you cannot lock your profit as effectively as you can lock your profit in the money covered call. Plus, when it comes to adjustment, doing in the money covered call adjustment is a breeze. What max gonna happen? Stock gonna crash, correct? It's crashing anyways, even when you do a cash secured put, right or wrong. Yes, in the money, what you gonna do? How you gonna roll that? But if you roll this, and there are many other ways by which you can really make sure that your in the money is effective. Also, one more point I want to tell you. When stock falls, what happens to IV of put? You tell me. I'm gonna give you 3 seconds. 1, 2, IV go up. So your put which you sold, it's gonna be really expensive. So your loss is going to be immense. Wherein, when the stock is falling, the negative situation, the call gets decay very fast. So when you compare both the things together, it will be a clear winner in front of your eyes. There will be no doubt left at all. That's why I say hit and trial way of trading, one needs to be completely avoided. Like you learn so many things in just very short amount of time. If you think trading is a craft, it's a business, then you can learn better techniques. Link is also on the first pinned comment. You touch that link, WhatsApp will open. Less monitoring, premium strategies are perfect for low stress trading. If you've been watching this video so far and you've been noting down all the points over the adjustments, how you can roll it, how the margin is, how you can use future instead of cash, if you want to use that demat account cash, in other strategies, how you could do it, how you can make a killer move when market go up. If you learned all these things, if you've been noting down, you know very well which strategy you never have to look. again in the future. And obviously, you can do synthetic exits, like I told you, very effective, very powerful. All right, so thanks for watching the video. And like I always say, you are going to do so well in trading, you will surprise everyone. I wish you all the best.